Stocks are supposed to reflect a company's value. The problem? They don't. Or at least not in the way that you think. A stock is only worth what people believe it's worth, and that belief? It's fragile. It changes with hype, fear, and sometimes completely irrational decisions. It's all an illusion. But this simple fact can actually help you infinitely when investing. How? Well, we're getting there. I have a $100 bill right here in my hand. We all know what it's worth, right? It's written right here. Well, what about this banana? In a grocery store, it's 30 cents. But on a desert island with no other food, it's priceless. Value is not fixed, it depends on context. And in the stock market, that context is shaped by people's emotions. The date is May 1st, 2020. Elon Musk tweeted, "Tesla stock is too high in my opinion." Or X? I don't even know anymore. And the stock proceeded to dump 10% in the hours following the tweet. Did Elon Musk tweeting this suddenly decrease Tesla's value by $15 billion? No, it doesn't really mean anything in the grand scheme of things. And yet, because stocks are worth what people say they are worth, there was such a huge reaction to something completely harmless. Or take GameStop, which was a struggling retail chain with a bleak future. And yet it became a $40 billion company in the snap of a finger because a group of people on Wall Street bets decided it should be. Do you see the problem? Stock prices are not objective. They're not based off some universal truth about a company's value. Instead, they reflect what people are willing to pay. And that can change for all sorts of reasons, some logical, some not. Let's play a simple game. I can give you $200,000 guaranteed. Or you can flip this coin, and if it lands on heads, I'll give you $1 million. Mathematically, you are much better off taking the second option, but would you take it? Most people wouldn't. Because psychologically, we hate losing much more than we like winning. We would much rather be guaranteed $200,000 rather than having 50% chance of winning $1 million, because we're definitely scared that 50% chance of nothing. This shows how many people often act irrationally when it comes to money. They are subject to biases and will listen to their heart over their head. This exact phenomenon affects the stock market. A company can miss earnings by 1 penny per share, and a stock can drop by billions of dollars overnight, even though in reality, their earnings miss barely changes anything but the company's long-term future. And this is why the stock market isn't about business, finance, or math. It's about psychology. It's that same psychology that will prompt you to click that shiny red subscribe button. Now, you might be thinking, if the stock market is based off perception, can I take advantage of that? Well, yes, you can. We'll get to that. So, is the stock market real? Well, yes, money changes hands, people get rich, people go broke. But can it actually tell us what companies are worth? Prices don't go up because they should. They go up because enough people believe they should. But what if they shouldn't? The year is 1999. The internet is developing fast. Everyone is throwing their money at the companies at the forefront of this new revolution. Do you know how much of a big deal this is? It's literally free money to be part of this. Why not invest? And because of this pure euphoria, internet stocks went up hugely. Cisco is one of these stocks, going up like 1,000%. But the following year, the illusion broke. People realized that while the internet was certainly exciting, it did not warrant this hype. And so market bliss turned to fear. And in a market where fear and greed dictate everything, that led to bloodshed. The Nasdaq ended up crashing 80% in the dot-com crash. We're not talking about a meme stock, we're talking about a goddamn index fund, just so we're clear. Does the dot-com crash sound familiar? I don't know. Could Nvidia be the next Cisco? We are currently in another period of euphoria, but now with AI rather than the internet. I'm not here to tell you if stocks will go down because I suck at investing, but just question if this is an illusion. And if so, the illusion will eventually be broken. That's all I'll say. Statistically, most of you watching this probably all suck at investing as well. Even if we see an illusion, it's very hard to know when it'll be broken and how to capitalize off it. The market can and will stay irrational longer than you can stay solvent. If everyone thinks Tesla's worth $1 trillion, then Tesla is simply worth $1 trillion. But there is actually one easy way. Just wait. Over time, the market's efficient mechanics will rectify a stock's market value to the true value. By investing for the long term by buying index funds or whatever, you are instead betting on the actual value of companies rather than just trading off of illusions, which is the quickest way to throw your money into the toilet. Most people do think that index funds are very simple. But if you don't know this one key thing about them, you could be leaving thousands on the table. Click here to find out. I'll see you there.